When you look at today's markets, I mean, the flash, the speed, all the meme stocks, the crypto waves, it really makes you wonder, doesn't it? What would Warren Buffett actually make of all this? And maybe more importantly, what can we, trying to navigate this chaos, possibly learn from him now?
That's a great question.
And that's exactly what we're diving into today. We're not just reading Alice Schroeder's huge biography, The Snowball, Warren Buffett and the Business of Life. We're really taking apart the analysis from some fantastic sources you've shared with us. We want to deconstruct the core logic, really.
Get to the heart of it.
Yeah, extract the absolute most important nuggets from this foundational text. Our mission, really, is to pull out those key insights into Buffett's thinking, his philosophy. And not just about investing, right, but about what the book calls the business of life.
Right, it's broader than just finance.
Exactly. Because, as Schroeder shows, and she had this incredible access, the book gives us a truly candid, kind of unvarnished look at his mind. You see the strengths, sure, but also the acknowledged frailties and how his ideas actually evolved over time.
It's a very human portrait in that sense.
It really is. So let's just get right into it. To understand why this book, nearly 1,000 pages, about someone who sometimes feels like he's from another era, why it's still so profoundly relevant today. Well, first we have to understand the fundamental market problem Buffett was constantly battling. What were those core sins, you could say? The pervasive flaws in how investors think, the ones Schroeder chronicles him fighting against.
Well, the analysis really points to three main things he consistently pushed back against. Pervasive short-termism, that's a big one.
Always chasing the next quarter.
Exactly. Then speculative frenzy, getting caught up in bubbles. And finally, just emotionally driven decision-making, letting fear and greed run the show.
And these aren't new issues, are they? I mean, they seem amplified now, maybe, with technology, but...
Oh, definitely not new. But yeah, maybe amplified. It's that perpetual human tendency, isn't it? Chasing easy gains. Reacting to noise instead of signal.
And the book shows this wasn't just a modern thing for him either. Schroeder details how his disciplined philosophy stood out so much against the speculative go-go years back in the 1960s.
Right. He was dealing with that kind of irrationality way back then.
Just like he navigated the dot-com bubble in the late 90s. It's this constant battle because, like you said, it seems rooted in just unchanging human psychology, even if the market's technology changes.
Precisely. The core problem, as it's laid out in the sources, is investors treating stocks like they're just flickering blips on a screen, totally disconnected from the actual businesses underneath.
Yeah.
They just succumb to the mood swings of Mr. Market, that brilliant allegory Ben Graham created.
Representing the market's irrational swings, between total euphoria and complete despair.
Exactly. Falling prey to that manic depressive nature.
And there's another big flaw the book sort of implicitly tackles, isn't there? This seductive illusion of sophistication. Finance often seems to reward complexity, or at least the appearance of it.
Oh, absolutely. But Buffett, as Schroeder really shows, was this relentless champion of radical simplicity. Understand what you own, stay within your circle of competence, don't pretend to know everything.
So if we were to boil down the Snowball's core message, what would it be?
I think the central thesis derived from the analysis is this. Enduring success, whether it's in your investments or just, navigating life, it comes from the relentless, patient compounding of rational decisions.
Right.
It's about having an unwavering focus on intrinsic value, maintaining steadfast personal integrity, and crucially being guided by an internal compass, your own values, your own understanding, rather than constantly looking outside for validation.
That idea of relentless, patient compounding. It's right there in the title, The Snowball, isn't it?
It's the perfect metaphor.
It really is. This core concept that small, consistent, intelligent efforts, whether that's sound investments, continuous learning, ethical conduct, applied over really vast stretches of time, they accumulate. They build into something extraordinary.
And it applies across the board, financial wealth, absolutely, but also knowledge, reputation, even wisdom. It all compounds.
The analogy used in the source material is pretty powerful, too. It said most investors are out there trying to catch lightning in a bottle, right? Hoping for that one big, quick score.
Like the lottery ticket mentality.
But Buffett, as Schroeder shows him, was meticulously, patiently building a hydroelectric dam. Something that grows steadily, reliably, becomes immense, and produces enduring power over decades. Not flashy, but incredibly effective.
A completely different game.
Totally. And for that whole snowball effect philosophy to actually work, I mean, really work in practice, what are the foundational beliefs? What are the maybe unstated assumptions you have to hold? Because this approach, it isn't for everyone, is it?
That's a really key point. The sources highlight a few absolutely fundamental beliefs. First, you need an unwavering faith that rationality and intrinsic value will eventually prevail over market irrationality. Maybe not tomorrow, maybe not next year, but eventually.
That sounds like it comes straight from Benjamin Graham.
It's a direct inheritance. That deep conviction that businesses have a fundamental worth independent of the price tag the market slaps on them moment to moment, and that over time, price and value will ultimately converge.
And his legendary patience makes sense then. Those incredibly long holding periods. I mean, thinking about Coca-Cola since the late 80s, or sticking with American Express through that crazy salad oil scandal decades ago.
Right. Those actions only make sense if you truly fundamentally believe that the underlying business reality matters far more than the market's fleeting sentiment or panic.
Absolutely. What's the second core belief?
The second is just a profound belief in the sheer power of compounding, and understanding that time is its absolutely indispensable partner. The title, The Snowball, his incredibly early start in earning and investing as a kid.
It all points to that.
It all underscores his deep faith in exponential growth. Growth driven by the consistent reinvestment, not just of capital, mind you, but also reinvestment of effort, of learning. Patience isn't just a virtue here, it's a core strategic necessity.
Which leads to maybe the deepest point the book makes, wouldn't you say? The belief that ethical behavior and a solid reputation are themselves compounding assets.
Yes. And this isn't just presented as some nice moral preference, it's framed as a practical, implicit assumption.
How so?
Well, Schroeder's account strongly suggests that Buffett's integrity actually unlocked opportunities for him, helped build crucial partnerships, and critically protected him against potentially catastrophic failures. The Salomon Brothers scandal is maybe the starkest example.
Where his reputation was basically the only thing that could save the firm.
Exactly. His system, the analysis suggests, implicitly relies on the idea that the market, over the very long term, does tend to reward trustworthiness. There's this vital moral dimension that underpins the whole structure. It's not just about numbers.
Okay, so we had these foundational beliefs. Rationality wins eventually, compounding is king, integrity pays off. How did Buffett actually translate these into a practical day-to-day approach? This is where Schroeder really gives us a look under the hood, right? At his, we could call it his mental operating system.
Yeah, that's a good way to put it. The book essentially breaks it down into a few key pieces that are all intertwined. There's the overarching mindset, then the specific tools he uses, and then maybe most importantly, the psychological element that kind of protects the whole thing.
Okay, let's start with that big picture mindset. Schroeder illustrates it as the absolute bedrock, the compounding mindset, and the long game. It's this idea that real success is built through patient, persistent accumulation and reinvestment.
Not just of money.
Right, not just money, but of knowledge, of reputation over extraordinarily long time horizons.
And you see this thread running through his entire life, don't you? Right from his earliest childhood ventures, selling gum, delivering newspapers, he was always looking for ways to reinvest his time, his focus, to compound whatever asset he was building at that moment.
The snowball metaphor again.
Yeah.
It needs the right kind of snow, like good businesses, rational decisions, ethical actions, and a really long hill, which is just time.
Exactly. And Schroeder shows that his genius wasn't just in identifying those things, which is hard enough, but in possessing the incredible discipline to actually let the magic of time and compounding do its work, resisting the urge to constantly fiddle.
And that disciplined long-term focus. It feels almost revolutionary in the context of finance today, doesn't it? Compared to the market's obsession with quarterly earnings calls or daily stock swings.
It's completely countercultural.
Holding companies like Coca-Cola for decades or Guy Ico for even longer. It's an act of radical patience. It directly counters that flaw, missing the incredible power of compounding because everyone's focused on the short term.
It's like planting trees. Most people want sunflowers, right? They grow fast, look bright for a season. Buffett was always focused on planting oak trees, things that provide deep, enduring value over generations.
That's a great analogy.
And it's not passive. That's important. Schroeder's portrayal makes it clear it's not just buy and hope. It's an active process. Learn, focus, understand, then hold. He's constantly compounding his own knowledge, too. That famous read 500 pages a day idea feeds directly into this.
Building on that compounding mindset, the book then reveals the specific tools he uses, his Value Investor's Toolkit. These are the rules, the concepts, drawn initially from Graham but evolved significantly over time, especially with Charlie Munger's influence.
Right. First up, you have intrinsic value. The book really emphasizes this isn't just some abstract number. It's a business's true underlying worth based on the cash it can realistically generate over its entire lifetime. And crucially, it's totally separate from the market's often volatile price tag.
So it's the anchor.
It's the anchor of rationality. It combats that fundamental mistake of equating price with value.
Then, the margin of safety. Buying something significantly below your estimate of its intrinsic value. Why is that so critical?
Because we're all human. It's your buffer. It protects you against inevitable errors in your own analysis, against unforeseen problems that will crop up, against just plain bad luck sometimes.
Right.
It institutionalizes prudence. It's the polar opposite of paying a premium just because something is popular or perceived to be a high-growth darling. Think of an engineer designing a bridge. They build it to hold far more weight than they expect it will ever have to bear. That's the margin of safety.
Makes sense. And the circle of competence. Only investing in businesses you genuinely, truly understand.
The power here is knowing your boundaries, admitting what you don't know. It keeps you from chasing fads or getting sucked into complex businesses you can't really grasp.
It's about intellectual honesty, really, over ego.
Absolutely. And you see this play out historically, right? When he famously avoided most of the early tech stocks during the dot-com boom, it wasn't that he thought they were bad businesses necessarily.
He just didn't feel he understood them well enough to value their future earning power confidently.
Exactly. Outside his circle.
The sources also discuss that significant evolution in his approach, though the focus on quality businesses, often called the Munger shift, moving away from Graham's sort of cigar butt idea.
Finding discarded cigar butts with one puff left in them.
Yeah, towards buying wonderful companies at a fair price. This led to the whole concept of economic moats.
Yes, identifying those durable competitive advantages that protect a business's profitability over the long haul. Things like incredibly strong brands, think Coca-Cola again, or powerful network effects, patents, significant cost advantages.
Then why the shift? Why move from cheap to quality?
Because Munger helped him see that truly high-quality businesses can compound within themselves. They can reinvest their own earnings at very high rates of return. That makes the long game, the compounding, even more powerful than just buying something statistically cheap that might not grow.
Like a castle with a really wide moat protecting it from competitors trying to steal its treasure.
That's the classic analogy, yeah. It defends the profitability.
And there's that fascinating tool mentioned in the book, the idea of the 20-slot punch card. Imagining you only get 20 investment opportunities in your entire life.
That's such a powerful mental constraint, isn't it? It forces extreme selectivity. It forces deep, deep diligence before you commit capital. And it encourages making highly concentrated, high-conviction bets when you do find something.
So it fights against the tendency to just dabble, or what Munger calls diversification, making lots of small bets without real conviction.
Precisely. It forces profound thought. You're not just buying something casually, you're using one of your precious 20 slots.
So these terms, intrinsic value, margin of safety, circle of competence, moats, punch card, they aren't just buzzwords. As Schroeder's analysis really brings out, they form a powerful lexicon. They're like cognitive shortcuts, analytical frameworks.
Your tools for thinking.
Yeah, tools for thinking that allow for incredibly precise, rational thought about investing. They cut through all the vague, often misleading Wall Street jargon. Mastering this way of thinking, this lexicon, seems critical to the whole operating system.
Which brings us naturally to the third pillar, and arguably this is the most crucial one of all. The psychological armor, the inner scorecard, and emotional fortitude. Schroeder delves into this quite extensively.
Define the inner scorecard for us again. What exactly is it?
At its core, it's the conscious choice, the deliberate practice of judging yourself, your actions, your decisions, your self-worth, based on your own internal standards. Your principles, your understanding of a life well lived or a job well done, completely irrespective of what the market, the crowd, or the wider world thinks. That external judgment, that's the outer scorecard.
And Buffett has that famous question, right, about being the lover.
Yes. Would you rather be the world's greatest lover, but be thought by everyone to be the worst? Or be the world's worst lover, but be thought by everyone to be the greatest?
That cuts right to it.
That's the inner scorecard versus the outer scorecard question in its purest form.
And why is cultivating that inner scorecard so absolutely indispensable for an investor?
Because Mr. Market, our old friend, is fundamentally manic depressive. If your self-worth, or more practically your investment decisions, rely on his wild mood swings, which is the outer scorecard you're just going to be constantly tossed about.
Buying high when everyone's euphoric, selling low when everyone's panicking.
Exactly. The inner scorecard provides the absolute fortitude, the psychological strength to do the opposite, to actually execute on being fearful when others are greedy and greedy when others are fearful. It allows you to stick to your rational plan even when it's deeply unpopular or performing poorly in the short term.
And Schroeder traces this back, doesn't she, to his father's influence and shows how it guided him through some incredibly difficult moments.
Oh, yes. Ethical dilemmas, personal challenges, navigating scandals. That internal anchor was critical.
The analysis really confirms a crucial truth that Buffett seems to embody. That temperament, patience, discipline, emotional control is actually far more important than raw IQ for long-term investment success.
Absolutely. Raw intellect helps, sure, but without the right temperament, it often leads people astray faster. The inner scorecard is the bedrock of that winning temperament.
It's like an internal gyroscope, maybe?
That's a perfect analogy. It keeps you balanced, keeps you heading in your chosen direction, regardless of how violently the ship you're on, whether that's the market or just life itself, is being tossed around.
While everyone else, relying on the outer scorecard, is like passengers rushing frantically from one side of the deck to the other with the panicked crowd.
Making the instability even worse.
Yeah, so the inner scorecard enables genuine contrarianism, real psychological strength, detachment from herd mentality.
And it's not just theoretical, it's deeply practical, it's operational. It's what allows someone like Buffett to wait, sometimes for years, for what he calls a fat pitch. It's what allows him to make those massive, concentrated bets when the opportunity finally arrives. And it's what allows him to hold on through terrifying market downturns when everyone else is capitulating.
So cultivating is like a critical investment in itself.
Absolutely. With compounding payoffs that go far beyond just finance. They impact your overall life satisfaction, your sense of meaning, your resilience. Schroeder's portrayal of this aspect of Buffett is incredibly powerful, even if, honestly, it seems quite daunting to achieve.
It does. And what's fascinating, as you pointed out earlier, is how these three pillars, the compounding mindset, the toolkit, and the inner scorecard, they aren't independent silos.
Not at all. The book shows they are deeply interconnected, constantly reinforcing each other. Think about it. Without the long game mindset, why would you bother developing the patience required by the toolkit?
Right, you just want quick results.
And without the toolkit, the understanding of value, moats, etc., the long game could just become passive, uninformed waiting, hoping for the best.
And the big one, without the inner scorecard.
Providing that emotional discipline, that independent judgment. Well, a lack of fortitude will inevitably derail the other two pillars the moment things get stressful or uncertain. Fear or greed takes over.
So Schroeder implicitly, and sometimes explicitly, shows Buffett deploying them all in concert. They work together, reinforcing each other in both his investing decisions and his life decisions.
You really can't just pick and choose one part and expect the same results. The power comes from the integration, from the whole system working together.
And the inner scorecard really does feel like the master switch, doesn't it? The thing that enables the consistent, rational application of all the others.
I think that's a fair assessment based on the analysis, yes.
Okay, so we've explored this incredibly robust framework that Schroeder lays out in the book. But let's face it, many of these ideas were forged decades ago. How do they actually hold up in today's world? Hyperfast, tech-driven, globalized. And let's be honest, where might this model start to bend or maybe even break in the modern environment?
That's the critical question for anyone listening today, isn't it? Let's put it to the timelessness test first. How directly applicable are these core principles right now?
Okay, well, take a current market situation. What about these speculative rallies we've seen in things like AI stocks or other really hyped tech trends? How would an investor applying Buffett's principles, as described by Schroeder, approach that kind of thing?
Well, fundamentally, they would approach it with caution. Deep caution. Someone guided by that inner scorecard and the circle of competence would first ask themselves, do I truly deeply understand what this specific AI business does? How it actually makes money? What are its realistic long-term prospects beyond the exciting narrative?
Getting past the hype?
Exactly, then. What is its intrinsic value, really? Detached from the story, detached from the momentum. Is there any margin of safety at these kinds of valuations we're seeing? And critically, where are the genuinely durable economic moats in this space? Is it truly proprietary data or algorithms or unique talent or network effects? Or is it just fleeting momentum that could evaporate tomorrow?
So looking past the story to the fundamental business realities, the earning power, the competitive landscape.
Precisely, asking those hard, fundamental questions.
But what about his huge investment in Apple? That's a modern tech giant. Seems kind of outside the traditional old-school Graham value box, doesn't it?
That's a fantastic example, and the analysis suggests his Apple investment is a perfect illustration of adaptation, not abandonment, of the principles. He apparently didn't see Apple primarily as a complex, unpredictable tech company.
How did he see it then?
More as an extraordinary consumer products company. One with incredibly powerful intangible moats. The brand loyalty is immense, the ecosystem stickiness, the switching costs for users, and it generates phenomenal amounts of cash, owner earnings.
So he applied the enduring principles, intrinsic value, economic moats, just to a new type of company asset, the intangible ones.
Exactly. It shows the framework is adaptable, not rigid if you understand the core principles deeply.
And what about during big market panics, like the COVID crash in 2020 or way back in the 2008 global financial crisis?
Well, this is where the inner scorecard and the margin of safety become absolutely paramount when everyone else is panicking, totally driven by the outer scorecard, losing their minds.
Yeah.
The Buffett approach, as chronicled so well in the book, is to calmly, rationally assess. Are wonderful businesses I already understand and admire, suddenly available at bargain prices because of that widespread fear?
It's the greedy when others are fearful mantra in action.
Precisely. Using the cash reserves that were deliberately kept aside for exactly such opportunities. It's proactive opportunism grounded in discipline.
So it sounds like while the specific tactics of valuation might need to evolve, I mean, how you value a software company is different from how you value a railroad, right?
Definitely. The inputs change.
But the underlying principles, buy below true worth, understand what you own, demand a margin of safety, think long-term, maintain emotional discipline, those seem timeless because they're rooted in fundamental business realities and, well, enduring human psychology.
I think that's right. And Schroeder's illustration of Buffett's own evolution, the Munger shift, the later move into Apple, shows the framework isn't static. It's about intelligently applying core ideas to new situations.
The challenge for us, then, is internalizing those principles deeply enough to make those intelligent adaptations ourselves.
That's the real work, isn't it?
Okay, now let's flip the coin. Let's be critical. Where does this model genuinely struggle or face significant challenges in today's environment?
Right, the limitations. Well, one big challenge, and it's related to the Apple point, is valuing intangible, heavy, high-growth tech companies in general. Traditional value metrics, price to book, sometimes price to earnings, they often struggle when most of a company's value isn't in factories or inventory, but in things like brand equity, network effects, proprietary data, intellectual property.
Stuff that doesn't show up neatly on a balance sheet.
Exactly. And Schroeder's book, remember, largely covers a period before these kinds of intangible assets completely dominated the market landscape like they do now. It's genuinely complex to establish a clear, confident margin of safety when future growth is highly uncertain and driven by things that are hard to quantify.
And this leads to that common criticism, right?
Yeah.
That strict, old-school value investing can really underperform during long bull markets led by growth stocks. It can miss huge opportunities.
That's a valid criticism, yes. If you stick too rigidly to only statistically cheap metrics, you might miss the next great compounder whose value is primarily in its future potential and intangible moat.
What about the sheer pace of technological disruption?
That's another huge one. A durable economic moat is great, but it's being tested more severely and frequently today by swift, radical technological change. A moat that looked impenetrable 5 years ago can become irrelevant remarkably quickly.
Think Kodak versus digital photography.
Or Blockbuster versus streaming. The examples are numerous. The pace of change can genuinely exceed an investor's ability to maintain a deep circle of competence in rapidly evolving industries and confidently assess a business's long-term durability. The moat might just disappear faster than you realize.
There's also the risk of value traps, isn't there?
Oh, definitely. That's where a company looks statistically cheap on paper, but it's cheap for a very good reason. It's actually in secular decline. Its industry is shrinking, its product is becoming obsolete.
So the value keeps eroding.
Exactly. The cigar butt idea, finding those last few puffs, if it's applied without extreme caution and a forward-looking understanding of the business and industry trends, can easily lead you into investing in businesses whose intrinsic value is continuously melting away. Schroeder's analysis does mention some of Buffett's own cited mistakes, like Dexter's shoe, which unfortunately became a value trap. That highlights the risk.
And then, specific to Berkshire Hathaway itself, although maybe less relevant for individual investors, there's the too big to nimbly maneuver problem.
Right, that's more about scale than the philosophy itself, but it's a real constraint for Berkshire now. Its sheer size means it needs to make enormous investments. We're talking billions, not millions, just to move the needle on its overall returns.
Which limits the pond they can fish in.
It dramatically limits the universe of potential opportunities to only very large companies. And that inevitably makes it harder to generate the same percentage returns that were possible with a much smaller capital base decades ago.
What about macroeconomic factors or missed opportunities? Did the sources touch on that?
Yes, the analysis acknowledges Buffett has made admitted mistakes based on macro predictions, even though he primarily focuses bottom up. His investment in ConocoPhillips right before the 2008 oil price crash is sometimes cited. So while his bottom-up focus is a huge strength, it's not completely immune to broader economic forces.
On the missed opportunities.
Well, yes, he famously missed being an early investor in some of the biggest tech winners, like Amazon and Google. Part of that was clearly his discipline around circle of competence. He didn't feel he understood them early on. Part might have been a slower adaptation to valuing that specific type of intangible growth platform. It's a trade-off inherent in the approach. You avoid some blow-ups, but you might miss some rockets.
And finally, what about his specific advice for his widow's inheritance? That 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds.
Yeah, that advice sometimes draws criticism. People say, wow, 90% equities, that might be too aggressive for many retirees, or it potentially lacks broader diversification beyond just large-cap U.S. stocks. But the context provided in the source material is really crucial here. It's specific advice for someone who will be inheriting substantial wealth, who is not an expert investor, and whose fundamental lifestyle isn't likely to be seriously impacted by normal market volatility. It wasn't presented as, a universal one-size-fits-all template for every single person's retirement portfolio.
Got it. Context matters. So, putting all these challenges together, it seems the rise of intangible assets really forces a reevaluation of what value and moats even mean today.
I think that's fair. Moats today are often less about physical assets like factories and more about things like network effects, the stickiness of an ecosystem, proprietary data, algorithms, and value might be less about just low current multiples and more about accurately discounting future cash flows that will be generated by these new types of moats.
So while the criticism about missing some early explosive tech growth is valid, if you define value investing very rigidly.
Right, if you're stuck in 1950s Graham mode.
The core principles themselves, buying future earning power for less than it's worth, really understanding what you own, demanding a margin of safety, thinking long-term, they still seem robust if they're applied flexibly. Like we saw with the Apple example.
Exactly. The task for modern investors isn't necessarily to throw out the baby with the bathwater, to discard the whole philosophy. It's more about figuring out how to apply these timeless principles intelligently to this intangible, fast-changing economy, which, admittedly, requires new analytical tools, maybe different perspectives, and makes the journey perhaps more complex than it used to be. But the core philosophy, the analysis suggests, is still fundamentally valid.
Okay. We've journeyed through the logic of the snowball. We've tested its application to today's world. We've explored its limitations. Let's try to distill it down. If you could steal just one single indispensable mental tool from Warren Buffett's life, as portrayed in such incredible detail by Alice Schroeder, what should that one thing be?
Well, as we've discussed, the book makes it pretty clear his success comes from an integrated system, right? The compounding mindset, the value investor's toolkit, and the inner scorecard, all applied not just to finance, but to the business of life.
They're all connected. The power comes from using them together.
Exactly. They're deeply interconnected. Their power comes from that integration.
But if you absolutely had to pick just one, the ultimate takeaway, the core distillation.
Okay. If forced to pick just one, I think the overwhelming answer, the tool that echoes again and again through Schroeder's work and through Buffett's own reflections over the years, has to be the inner scorecard.
Let's just reiterate that clearly one more time. What is it?
It's the conscious, deliberate practice of evaluating your actions, your decisions, and ultimately your sense of self-worth based solely on your own internal metrics, your principles, your values, your authentic understanding of what constitutes a life well lived and a job well done. It's about striving to be, in your own eyes, praiseworthy, rather than just chasing being praised by the outside world, the outer scorecard.
And why? Why is that single tool so overwhelmingly powerful?
Because fundamentally, it's the psychological bedrock that enables all the other sound practices to actually function consistently over the long term.
Okay, break that down for investing.
For investing, it's what empowers you to be genuinely contrarian when necessary. It gives you the strength to exercise the true, deep patience that compounding demands. It allows you to maintain unwavering discipline, sticking to your circle of competence, demanding a margin of safety, even when it's uncomfortable. And maybe, most critically, it helps you avoid those emotionally driven decisions. The panic selling, the euphoric buying, which the sources consistently highlight as the primary destroyer of investment returns for most people.
And beyond investing, for the business of life.
Schroeder's portrayal really shows how it fosters unyielding integrity. It gives you the strength to do what you believe is right, even when it's incredibly difficult, unpopular, or costly in the short term. It cultivates deep authenticity, living a life that's true to your own values, which seems to be the foundation of sustainable fulfillment rather than just chasing external approval. And it builds profound resilience, the ability to withstand criticisms, setbacks, failures. Think about Buffett navigating SEC investigations, the whole Salomon Brothers crisis, personal challenges. That inner scorecard was his anchor through it all.
It really does sound like the ultimate enabler then. Without that internal compass, that gyroscope we talked about, even the most brilliant strategies get easily derailed by fear or greed or just the pressure to conform to what everyone else is doing, social proof.
Exactly. It's like the master switch that allows you to consistently apply reason, discipline, and long-term thinking, insulating you from the noise and irrationality of the crowd. Buffett's famously independent thinking seems to come directly from this psychological detachment from external validation that the inner scorecard cultivates over a lifetime. It's the ultimate source of the independent judgment needed for truly superior decisions in any field.
So cultivating that inner scorecard, building that unshakable psychological foundation, that's arguably the very first and maybe the most fundamental step, more important than learning any specific stock-picking formula or financial ratio.
Based on Schroeder's deep dive into his life and thinking, I think you could absolutely make that case. It's the foundation upon which all the other rational strategies have to be built if they're going to be successfully implemented consistently over the decades required for real compounding to work its magic.
And that brings us towards the close of our deep dive today, looking into Alice Schroeder's monumental work, The Snowball, Warren Buffett, and the Business of Life.
It's a book that, as we've explored, really reveals itself to be far more than just a roadmap to getting rich. It's almost a profound guide to crafting a life of substance, a life built on the compounding power not just of capital, but of wisdom, of intrinsic value, and perhaps most importantly, of unwavering integrity.
And the ultimate challenge that the book leaves you with, the one that really resonates most deeply after digging into it, is that intensely personal one, isn't it? The continuous lifelong effort required to cultivate and then actually listen to that inner scorecard, your own internal compass.
So maybe a final thought for you, the listener, to ponder after this discussion. Where in your own life, whether you're thinking about your finances, maybe your career path, or perhaps even just your day-to-day personal choices, where are you currently relying, maybe more than you realize, on an outer scorecard for validation? And how might consciously shifting your focus, starting today, towards building and trusting your own inner scorecard? How might that fundamentally change the decisions you make and ultimately your long-term sense of fulfillment?